It is 6 p.m. Pacific Standard Time, 9 p.m. Eastern Standard Time for those of you on the East Coast. This is the Dylan Holy Experience, and this is a very special edition of the Dylan Holy Experience. We're doing the midweek market recap on Tuesday. We're not even halfway through, and we're jam-packed with news, baby. Let's jump into it. Futures tied to the Dow Jones Industrial Average gained 47 points or 0.1%. S&P 500 futures added 0.4%, and NASDAQ 100 futures gained 1.2%. In regular trading Tuesday, the Dow fell about 344 points or 1%, and the S&P 500 finished 1.6% lower, and the NASDAQ composite dropped nearly 2%. Now, ladies and gentlemen of the millions, or hell, anyone who chooses to identify as anything but is a member of the millions, we are knee-deep in the thick of earnings season for Q1 of 2023. And let's start talking about what I believe is the single greatest company on planet Earth, the single greatest restaurant on planet Earth, the single greatest business on planet Earth, the epitome of what is American cuisine. Ladies and gentlemen, let's talk about the crown jewel of the Dylan Holy portfolio. Let's talk about the McDonald's Corporation. McDonald's earnings beat estimates as U.S. traffic grows despite price hikes. Let's take a look at our earnings per share. They made $2.63 per share versus the $2.33 expected, an absolutely killer earnings per share metric. Revenue up $5.9 billion versus the $5.59 billion expected. Net sales rose 4%, and all three of its divisions reported same-store sales growth of $12.6 million. Now, there was a $180 million charge. The CFO of McDonald's, Ian Borden, said was related to terminating leases and employee severance as part of a corporate reorganization. Earlier this month, McDonald's laid off hundreds of office workers as it moves to become more efficient and eliminate silos across the company. That being said, McDonald's U.S. traffic rose for the third consecutive quarter, bucking the industry trend of slipping traffic as menu prices rise. Because, ladies and gentlemen, this is the Dylan Holy thesis on McDonald's. Obviously not financial advice, but just for the sake of transparency, as you all know, this is my single largest holding. I absolutely love McDonald's, and the reason why I think McDonald's succeeds in conditions like this is because when prices start rising, when the cost of living starts rising, people are going to start cutting out the unnecessary, frivolous expenditures, the biggest of which is dining out, eating out. So, yeah, once menu prices start rising, for mom and pop restaurants, obviously we want to see mom and pop restaurants succeed. I don't want to see mom and pop shops go out of business, but those are the types of businesses that are hit harder than something like a McDonald's, because what McDonald's has is brand equity, and what McDonald's also has is their food is still relatively cheap. I mean, shit, I go on the McDonald's app using my McDonald's points. I wish they called them my McPoints, but they don't call them McPoints. McDonald's, if you want to start using McPoints, I'll take some royalties on that, but we'll cross that bridge when we need to. But what makes McDonald's, in my opinion, the single greatest restaurant on planet Earth is the fact that it can keep prices so low. Like, I can get a 20-piece McNugget and 2 large fries for $5. What is in those 20-piece McNuggets and 2 large fries? I don't know, but I'm getting it for $5. And I think in conditions like this, that's what goes through people's minds. Because people are still going to eat out. In America, People go out at least once a week. And when they have to start cutting costs and the cost of living gets more and more expensive, they have to get cheaper and cheaper food from fast food restaurants. And McDonald's is literally like people talk shit on McDonald's. All my coworkers talk shit on McDonald's. They don't like McDonald's. They say it's nasty. They say it's low quality. That's the point of McDonald's. I'm not going for a 5-star, 3-star Michelin meal. I'm going because I need $5 nuggies. I want nuggies. Give me my nuggies for $5 and I want fry. And with that thesis that I take, the primate mind of mine takes, McDonald's hit a 52-week high today. We can take a wee gander here. If we take a look, I guess from CNBC, because they're the only ones that really post that, McDonald's has been hitting 52-week highs throughout this entire month, where the S&P 500, it's trending downward. But McDonald's today, the McDonald's Corporation is more valuable than at any other point of its existence. And yes, it's, in bull markets, it's not as fast as Apple. It's not a growth stock. It's McDonald's, but it pays me a 2% dividend, 2.09% dividend if you really want to look at it. And it's a dividend king. Or is it a dividend king? I know it's a dividend aristocrat. I don't know if it's a king. But I don't think McDonald's is going anywhere. Absolutely love this company. And they had a great earnings season. So I can't complain about that. I'll take it. Speaking of the single biggest companies in America, Coca-Cola beat estimates fueled by price hikes and higher demand. Earnings per share 68 cents adjusted against the 64 cents expected. Revenue $10.96 billion was the actual revenue versus the $10.8 billion that was expected from the overall market. So they beat on earnings per share and revenue. If we take a look at net sales, they're up 5%. The organic revenue, which takes out the impact of acquisitions and divestitures, it climbed 12% in the quarter, driven largely by higher prices on Coca-Cola's drinks. So it's not necessarily organic revenue. It's kind of just price hikes across the board. So they are making more money. But if we look at inflation, has for the last year is basically up 9%. And they climbed 12% in the quarter. So they did still have basically 3% of actual real revenue growth, which is still good in these market conditions, but it's definitely not the 12% number is definitely more foo-foo and flash in the pan than of actual substance. That being said, bada boom, bada bing. Coke reported a 3% volume growth for its sparkling soft drinks unit. Its namesake soda also reported a 3% volume growth of actual Coca-Cola, and Coke Zero Sugar volume rose by 8%. The company's water, sports, coffee, and tea division saw volume growth of 4%, and the actual coffee division for Coca-Cola, and its volume increased by 9%. Yeah, good for them. I own Coca-Cola. I'm an active shareholder in Coca-Cola. I like seeing good Coca-Cola news. Speaking of beverage companies that are absolute vanguards in this industry and also are in the Dylan Holy portfolio, PepsiCo had a fantastic quarter. Earnings per share, $1.50 versus the $1.39 expected. Revenue at $17.85 billion versus the $17.22 billion expected. So, hey, beat on earnings per share, beat on revenue. Can't beat that. Net sales rose 10.2% and organic revenue rose 14.3%. If they're using the same metrics as Coca-Cola, this organic revenue number is probably closer to 9.3, but if we take it at face value at 14.3, let's go, baby. I'll take it. Frito-Lay reported organic revenue increases of 16%. So, I'll keep bringing it up because they do like to skew these numbers. They like to have the highest number for shareholders. But even if you take in that 9% into account, from the inflation cost of living. We can take a look. It'll be 7%. But yeah, so 16 or 7% depending on how you look at it, or if that's how they're calculating it. But yeah, Frito-Lay's growing, Pepsi's growing, Coca-Cola's growing. We like seeing that, baby. That's what we like to see. And and PepsiCo expects this to keep growing because they have upped their revenue and earnings per share outlooks. So they're expecting it to be better than ever. And as a shareholder, I love that, baby. I love that. Speaking of earnings reports, General Motors raises its 2023 guidance as first quarter earnings beat expectations. Kinda. This was one of the more shoddy earnings reports. It's más o menos. There's some good stuff, there's some bad stuff. Let's see what I'm talking about. Earnings per share, $2.21 versus the $1.73 expected, so a fantastic beat on earnings per share. Revenue, $3.99 billion versus the $38.96 billion expected. Hey, beat on revenue, can't beat on earnings per share and revenue. Like, if you can get both of those, from like those are probably the two most important metrics if we're just taking it at face value. So yeah. That's all the good. That's all the good. If we take a look at their net income in the first quarter was down roughly 18% compared to a year earlier. So year over year, it's down 18%. Not fantastic. They did have some layoffs. They were doing some salary buyouts, all that fun stuff. They also are cutting, if they are going to show it here. Yeah, they're also ending production of their Chevy Bolt, which is their highest selling and most affordable EV. Okay, Chevy, we'll see how this plays out. That's all I'm going to say. Chevy, we'll see how this plays out. I don't know if this is a great call because they already have the economy of scale and the supply chain figured out with the Bolt. It's a bold decision for sure. But we'll see what happens. I don't know if I would have done it personally, but the executives over at General Motors, they probably have a different opinion. They clearly have a different opinion, and we'll see what happens. Continuing on to earnings, we are in the big tech part of these segments. The big boys, the guys that really hold up the S&P 500. Alphabet reports revenue and earnings beat for the first quarter. Alphabet had a fantastic earnings report. And what's crazy about this, without leaking any names or anything, I had a member of the Dylan Holy experience. They reached out to me and they're like, listen, you need to buy Google. And I'm like, all right, what's going on with Google? And they're like, listen, their AI division is going to blow it out of the water. In 40 years, I want you driving a Ferrari off Google stock. So hearing that, doing some research myself, I decided to throw a bit of my portfolio, about 2 to 3% of my portfolio, into Alphabet or Google, for those of you that want to call it by its old name, its dead name, if you will. Alphabet reported a 10% beat on earnings per share, so they made $1.17 per share versus the $1.07 expected. Revenue, $69.79 billion versus the $68.9 billion expected. So they beat on earnings per share and revenue. Can't beat that. YouTube advertising revenue beats. Google Cloud revenue beats. And traffic acquisition costs slightly underperformed. But hey, what are you going to do? That's life, baby. That's life. Their actual revenue rose by 3%. And for the first time ever, if we can take a look at it here, they have generated a profit for its cloud computing business about a year ago. So if we take a look at the year-over-year revenue or profit, of the cloud computing business for Google, a year ago in Q1 of 2022, they lost $706 million of operating income. Like they lost $706 million, and they brought that to a profit of $191 million in the quarter. So they turned that boat around, and for the first time, they got their cash cow going, dude. That's how Amazon makes their money. That's how Microsoft makes their money, and that's how Google gonna make their money. And hey, now that I am a Google shareholder, more power to them, man. Another big thing that I think was fantastic. Where is it here, baby? Where is it here? They authorized a $70 billion share buyback. Now, here's what's interesting about this. That's following a 12,000 employee layoff. About 6% of Google's workforce they laid off in January. And then in the next earnings report, they authorized a $70 billion stock buyback. Now, some are going to say this is coincidental, but let's be honest here, it's not. And this is actually what a lot of big tech companies have been doing. Meta, they authorized a stock buyback. Meta, they're doing a $40 billion stock buyback. And that's after they laid off, 13% of their entire workforce. So, as a shareholder, I think this is a good thing in terms of what Google probably had to do to be able to afford this stock buyback. Not as ideal, but from a strictly shareholder standpoint, Google had a pretty great quarter. And I'm excited for the $70 billion stock buyback because that's going to make my shares a little more in the money, in theory, and I'll take it. Speaking of big tech companies, Microsoft beat on earnings per share, making $2.45 per share versus the $2.23 per share expected by analysts. Their revenue was up $52.86 billion. Excuse me, I'm a touch parched. Versus the $51.02 billion expected from analysts. Beat on earnings, beat on revenue. Hey, baby, what more can you ask? I sound like a broken record, but what more can you ask, for real? Their net income rose $9 billion. I don't know if this is like a cost of living, inflation kind of thing, or if this is organic, but nonetheless, net income rose 9% year over year. Revenue from Microsoft's Intelligent Cloud business segment, which includes the Azure Public Cloud, Enterprise Services, SQL Server, and Windows Server, generated $22.08 billion in revenue, up 16% from the year prior, and higher than the $21.94 billion consensus expected among analysts. So, hey, big tech is back, baby. Big tech is back. Microsoft is up like 16% in the last 3 months. So, I do like Microsoft is definitely a cash cow. They are the enterprise big tech play. They're also moving in with ChatGPT. Their 50% acquisition of OpenAI with that, and of course their being integration with it. So Microsoft is on the up and up. I think Microsoft is truly a cash flow king. And I'm happy to be a shareholder. Speaking of companies I'm a shareholder of and are also big tech. Oh my God, I deleted it. Uno momento. There we go. Apple, in their case against Epic Games, has officially declared a resounding victory in appeals court on Monday, mostly sided with Apple over its App Store rules in a suit with Epic Games. Now, they say most of the appeals courts. It was 9 out of 10 claims sided with Apple. And if people don't know what's going on with the Apple and Epic Games case, or didn't know what was going on with it, Apple and Epic Games, they make Fortnite. Listen, so let's talk Fortnite. So Epic Games makes Fortnite. Fortnite was on the App Store, and games or apps that are listed on the App Store, some of them have microtransactions. And Apple, they provide the payment rails for microtransactions through the App Store. And Apple takes a 30% cut in most cases from those payment rails, so they can just make a bunch of money. Because what are you going to do if you're on an iPhone? Try to sideload Fortnite? Not happening. You're gonna download it through the App Store because it's secure and safe and vetted by Apple. And you're going to buy V-Bucks. And Apple's going to take 30% of it. That was just kind of the deal. So what Epic did, because they didn't want to pay that 30% to Apple, they set up their own payment rail within Fortnite to be able to, keep 100% of the profits, or, like 3% after you have to pay their credit card fees and stuff like that. But they were basically trying to bypass Apple's 30% tax on microtransactions. Apple didn't like that. Apple kicks Fortnite off of the App Store. Epic sues Apple over antitrust concerns because they believe that Apple wields too much power over the App Store and are way more punishing than they need to be in terms of these fees. So it was brought up, and the 9 out of 10 claims in the appeals courts have decided in Apple's favor. So not much is really going to change. I don't see Apple losing control over their App Store, and I don't see Apple cutting down their transaction fees. And that's it. So another win for big tech. Kind of sucks because I understand that Apple, as a private corporation, they have complete control over what they want on their App Store. Totally fair. I can definitely understand that. The issue is they are charging a fee of 30%. And I feel like that is way more exorbitant than it needs to be. I could see 10%. I can understand 10%, but 30%, that's crazy. That 30% tax that they take contributed to a $78.1 billion profit or revenue. $78 billion in Apple revenue for fiscal 2022. So this is a cash cow for them because it's easy. They literally, the only service that they provide is security and the place to be able to put the actual app and, a billion devices that it can download from. That's all they provide to Epic. And they're taking 30%. Maybe Apple deems it's fair. I don't know if that's fair. And listen, I use Apple products. I have an Apple Watch on. I have an iPhone. I'm an active Apple shareholder. And I have AirPods. I like Apple. I think they make the greatest consumer goods on planet Earth. Doesn't mean I worship them. And this is not something that I believe that they should be worshipped in. And I think Apple's probably wrong here. And I think there needs to be more regulation and consumer protections against big tech. Not just Apple, though. Google's doing it too. Google also charges 20 to 30%. Google is no better, but Apple's a little worse of an offender in this case than Google. Speaking of, what were we looking at? Yeah. Not speaking of, this is a total conversational left turn. J&J, their consumer health unit, is going to be valued at $40 billion. Ahead of its IPO. So for those that don't know, Johnson & Johnson later this year is going to be splitting into two companies. They're going to keep Johnson & Johnson. That's going to be like a healthcare, medical science business. So they're going to be making medicines and new types of surgeries and stuff like that. So that's what they're investing into with Johnson & Johnson now. That's their focus. Kenvue is going to be their new consumer health company that they're spinning off, and it's going to be valued at $40 billion. Kenvue is basically going to take over the Johnson & Johnson wing of business that manufactures Band-Aids, Neutrogena, Aveeno, Tylenol, J&J baby powder, and more. So it's going to be their products, their consumer products industry. They're spinning that off into Kenvue, and I kind of like it. I kind of like Kenvue. I'm not going to lie. I'm not an active shareholder in Johnson & Johnson, but everyone who's an active dividend investor, which is what that's the type of single stock investing that I do like to do. I like dividend investing. So I know Johnson & Johnson is a big company among the dividend investor community. So maybe I'll take a further look at it. Maybe I'll rotate and diversify some of my portfolio into it. As for which one's going to be more profitable, I don't have any numbers on that, and I don't claim to. I like Kenvue. I think I actively don't buy anything other than Band-Aids now. Band-Aids, I can get away with a lot of generic brand stuff, but Band-Aids, I will not skimp on Band-Aids, dude. The adhesive on Band-Aids are better than any of the generic adhesives, and I stand by that. There is not a business that makes bandages better than Band-Aids. Fight me. I am not an active shareholder in Johnson & Johnson, nor do I advocate anyone be an active shareholder in Johnson & Johnson. Moving on from, this was, in my head, this segue was going to be the last segue. But if we're talking about the number 40, First Republic Bank says its deposits tumbled 40% to $104.5 billion in the first quarter. They say they have stabilized, but yeah. Bank run. Yeah, no, this is what a bank run looks like. Deposits tumbling 40% in 3 months. No bueno. Basically, within like 3 weeks, deposits tumbled 40%. Absolutely absurd. They got a $30 billion bailout from most of the major banks in America. Seems to have saved them right now, but yeah. First Republic, not doing fantastic. They hit a 52-week low today. They're down 50% from the start of today. If we take a look from the last year, they're down like 99%. So, and then if we go even further than that, it just gets uglier and uglier. But yeah, sorry for anyone that has their money at First Republic Bank. That's ass. Brutal. All right, moving on. Home prices for the first time in 8 months, they actually rose. They did rise 0.15%. But if we take a look at this WE graph here from Case-Shiller and interpreted by Lance Lambert and Fortune, this basically shows from 2000 to 2022 what happened with housing prices. And even in these portions of like massive declines of housing prices decreasing, there are some instances of housing prices increasing, and after a massive move down, we are getting some relief coming back to the upside. Again, can't speak on what's going to happen in the housing market. I will say housing prices, according to the Federal Reserve, have stagnated after the mortgage rates have more than doubled. And housing is it is the most difficult and unattainable time to become a homeowner. Like right now. It is horrible. It's a horrible time to become a homeowner. Like to finance a home. So I think that we're probably going to see some further downside. Obviously not financial advice. Obviously not telling you to long it or short it. I'm just giving my opinion. I think that housing prices need to come down to return to equilibrium. So anyone that's saving up for a house, I would recommend just store some cash to the side. Live in your abode for right now if you can still afford it. And just stockpile some money for whatever's going to happen next. I think housing prices go down from here still. But what are you going to do? Speaking of, industries that have been impacted by COVID-19, because the housing market was definitely impacted by COVID-19 and record low interest rates and supply chain issues, so were cars. The automobile industry absolutely exploded. Used car prices. Dude, I bought a Corolla in 2021. I bought it for, I think I financed it at $21,000. That same Corolla in 2020 was $16,000. So it was like a 20% increase from where I had bought it at. At the peak of the car dealership's supply chain crunch, that same Corolla was going for $30,000 pre-tax, pre-fees, pre-registration, anything. So it was going to be like $33,000 to $34,000 for a Corolla. But according to this metric here, it seems like car dealer and inventory levels are steadily coming back up. And we are getting some equilibrium in the marketplace. Let's take a look. Car supply for car dealers is measured in days, and the industry standard is to have a 60-day supply of cars. The average car dealer now has a 56-day inventory, a 58% increase from last year. So we are steadily marching our way back to supply chain equilibrium. Good. That's a good thing. High interest rate supply chain returning to equilibrium. Boom! Dylan Holy took the words right out of Dylan Holy's mouth. And consumer fatigue are most likely the catalysts for the supply swelling. People don't want to finance an auto loan right now because rates are so high. Anyone who bought a car within the last, 2 to 3 years, I think they're good with their cars. They probably don't want to move upward, and it's getting cheaper to make cars again. So all this stuff playing together, there's a swell of inventory on the dealer lots right now, and I think that's a good thing. We are returning to equilibrium, and that's all that matters. Speaking of returning to equilibrium, this is strictly a joke for members of the millions. Biden and Kamala Harris have officially announced their 2024 re-election campaign. So we're getting Joe Biden, probably. I think he's probably the presumptive Democratic nominee. I don't see anyone really running against him now that he and Harris are officially doing their campaign trail. So we could run it back. Biden, Trump, 2, electric boogaloo. Biden, DeSantis. Biden, Elder. Larry Elder's running for president in 2024. So let's see what happens. It should be fun. Of course, you know that Dylan Holy on the Dylan Holy Experience, as well as my motley crew of socialists and capitalists and Republicans and Democrats and all that fun stuff. They're all going to be getting together on the Dylan Holy Experience for a 2024 election extravaganza. Obviously, we are, we're a year and a half out from that, but I guess we're already setting it in stone, right? We're going to make it happen. Speaking of Fox News, which is where this morsel of information is from, Fox News has parted ways with Tucker Carlson following the Dominion lawsuit, and on the same day, Don Lemon and CNN parted ways. So a major shakeup in the broadcast journalism industry. Moving on, 20% of Gen Z is LGBT. Obviously, I'm not going to say they're evil. This is demons in America coming to fruition, ruining our children. I'm not going to say any of that. That's ridiculous. That's stupid. Obviously, for the 20% of Gen Z adults that identify as a member of the LGBTQIA plus community, more power to you. Dylan Holy Experience loves you exactly the way you are. But it's certainly interesting that it's the rate of Gen Z that is in this identifiable demographic is nearly double that of millennials, nearly over 6 times that of Gen Xers, and nearly 10 times that, or nearly 9 times that of baby boomers, and then traditionalists, they don't, 1.7%, so almost 20 times or 19 times higher. Again, these are just numbers. If you're gay, good for you. If you're lesbian, good for you. If you're bi, good for you. If you're trans, good for you. Dylan Holy Experience. We're just about getting that bag. And that's it. Love one another. Pride Month, almost here, almost a month away. And 20% of Gen Z identifies as LGBT. Triple H has unveiled a new World Heavyweight Championship for WWE. This is just beautiful, man. This is just a little beautiful belt. It took me a minute. I was looking at it. I'm like, I don't know. I like it. I think it looks cool. And I hope that they end up making a new design for the WWE Undisputed Universal Championship. I think that would be really nice. But World Heavyweight Championship looks beautiful, and we're gonna have a world champion presumptively on Raw, at least if Roman Reigns doesn't get drafted to SmackDown, stays on SmackDown. But we're gonna have a world champion on both brands now, not just Roman, floating in between. And I'm looking forward to that. It's gonna be some good television. And with that, I believe the Dylan Holy Experience special edition of the midweek market recap is coming to an end. Now it's time for our subtle little plugs. First things first, twitch.tv/RealDMH. That's where half of y'all are watching me right now. Go ahead and give me a follow. RealDMH. We're live every Wednesday, typically, and sometimes on Saturday and Sunday, but always on Wednesdays, and at least in this case, a special edition on Tuesday. YouTube.com/@DylanHoly. We have some content up for you right now. We're also live streaming to you. Once again, YouTube.com/@DylanHoly. I'm giving the millions the information and entertainment they so very need. And lastly, but certainly not least, go ahead and follow me on Twitter @RealDylanHoly. I'm giving y'all the best news, hand parsed, that I can find for y'all. And of course, you're also going to be the first to know whenever I'm live on the Dylan Holy Experience on YouTube or Twitch. Twitch or on the members of the millions on Twitter, they get like an hour heads up. So go ahead and follow me if you want to stay up to date on whatever is going on in the marketplace. We're always doing key takeaways. Whenever the market is open, the Dylan Holy Experience is always open. And I'm breaking down the most important things to happen in the market during the entire day. I always give breaking news. Earnings season has just been going off and everything in between. I also do some bullshittery, I also do some shit posted. That was a sneeze, not me crying. But yeah, twitter.com @RealDylanHoly. Go ahead and give me a follow. I love you all. Thank you so much for watching the special edition, Tuesday edition of the Midweek Market Recap. You all have a great rest of your day, and I'll see you at some point.